Hi, everyone. I wanted to thank you so much for attending tonight. We know that you have a lot of choices with your time, and obviously it's dinner time. So we appreciate all you guys actually spending your dinner with us tonight. We won't be eating, we'll just be talking, but you guys are also welcome to eat while you listen to this. So we won't see you, so you can go ahead and do what you need to do while you're watching this session to make this fun and enjoyable. We're hoping to make this evening really exciting for you tonight and answer any questions that you might have. Those who are watching this video in replay, we also want to thank you for taking your time as well to watch this video in replay. We're pretty excited about the webinar, and without clients like you guys who are asking these great questions and wanting to learn more about this, these sessions actually wouldn't occur without you. So what we've done is tried to take people's interest and questions and tried to tie it into a webinar. And as some of you may have seen this morning, a webinar series just on Canada Life and how the PAR account actually is performed with Ryan Marcy happened this morning. If you haven't got that video, you can certainly get that off of our YouTube link or ask Trish, and Trish will get that to you right away. But today we're really grateful not only to have our team here, as you see, and our team, this gracious team that actually, otherwise also, none of these things would happen without them. Because many of you see our immediate team, but you never get to see our extended team. And Brad Hyde is one of these extended team members that we have that we work with quite often. Brad is the Director of Tax and Estate Planning. So he's been in the industry for 30 years and is one of our greatest resources in the fact of, customizing advanced estate cases, high net worth files, many business succession plans with us. He also likes to golf. So, if you ever want that, we could tee up a golf game and some advanced tax and insurance planning as well. But we just wanted to thank him as being part of the team that's going to lead this presentation today. So thanks, Brad, for coming. And if you guys have any questions during this presentation, put up a hand and put in our chat section and in the question section. And we will actually, you don't even have to put up a hand. You could just type those questions in the chat section, and Trish will grab them at the end of the session. So if you have questions while the session's going on, just put those questions in right away, because then at least Trish can even interrupt occasionally and say, hey, we've got this really good question that pertains to this. And we'll get all the questions answered, because tonight we want it to be fun. We want it to be interactive. And the more involved everybody is, I think that, you really get a customized session to you. So I will introduce Brad Hyde. Thanks so much, Brad, for joining us today.
Thanks, Pam, and thanks, Pam and Kelly and the Tower Group for inviting me to participate tonight. I always enjoy the opportunity to talk with clients. I was kidding around with Pam and Kelly earlier that I don't get to do seminars with clients as much as I used to, but I've been doing this for many years, as Pam said. So with that, we'll jump right in, and our topic tonight is around PAR insurance and why it works inside a corporation and how it can help with retirement income planning. So getting started, I thought I'd start with an agenda, and our agenda tonight really is just giving some basic fundamentals around how corporate cash flow moves, and then talking about some issues that have come up in the last couple of years that relate to passive investment assets and why it's important to understand how your investments are being handled within your corporation and what the tax implications are of that investment inside your corporation. We're also going to touch on some government restrictions on investments, and we're going to move through that into building an optimal corporate investment vehicle. So we're going to talk about some of the characteristics that investment vehicles have and what are some of the things that we would all like to see in a corporate investment. And we're going to tick off some boxes on what a PAR policy, a PAR life insurance policy does within your corporation as it relates to those optimal investment options. Okay, and then we're going to look at the corporate insurance policy in a corporate context. And as we do that, we're going to talk about the three phases of of accumulation, retirement, and distribution. It's really important when we talk to people about this that we understand what's happening in each of those stages of development of the policy, as well as your growth and development with your investments. And then we're going to have some questions. If you have any questions, or if I do such a good job that I answer all your questions, then we'll just have a good chat at the end. So if nobody's got any objections, that's the agenda that we're going to handle. And if you have objections, it's still the agenda that we're going to go with tonight. Okay. So let's move forward. So I like to do this this diagram, and this diagram to me is just a visual depiction of what is and how does corporate assets move into your corporation and out of your corporation, and where is the tax implications. So here we have Bob. He's got a holding company, and the holding company owns shares in his operating company. This is a very common structure out there. That operating company can be a professional corporation, it can be a normal operating business like a manufacturing business, or any of the like. But most often I'm dealing with a lot of clients that have a professional corporation, and there's sometimes a holding company there, and that holding company would own maybe the building that the professional is operating out of. That would be the more common structure that I would see in that situation. So we have revenue that comes into the operating company, and that revenue is then going to be paid out to Bob, our owner, and usually it's paid out as a result of salaries, dividends, or bonuses. And then any money that doesn't get paid out from that revenue that came in is going to get pushed up to the holding company. And we do that so that we can separate some of the liability, and so that we're not commingling the investment assets in the operating company, because sometimes we sell operating companies. And if we sell an operating company, we don't want to have that cash sitting in that company. So we push it up to the holdco, and then we have investments that we make at that holdco level. And those investments will generate some income, and that's considered passive investment income. And when we have passive investment income inside a corporation, what we're really ending up with is a very high tax rate on that investment income. In Alberta, we're at 46.67% on passive investment income. So we try and do things with our assets inside the corporation that are being held to minimize that tax implication. Okay, but on the stuff that we can't minimize, we've got taxes on the investment income and any dividends that are paid out, and that money's gone to CRA. There's a huge opportunity cost of losing that money. If we don't have it growing for us and it's gone to CRA, it's gone forever, right? So sometimes we pay out dividends from the holdco as well. And so it's just different flows and different transactions, but this really gives an underlying overview of what we're talking about tonight. Okay. So I just want to touch a little bit more on the taxation of passive investment income inside a corporation. One of the things that I've already mentioned is that income that's in investments that's not used for active business growth is considered passive income, and that tax rate is 46.67 in Alberta. But we also have a passive investment rule that changed in 2019. They actually passed it in 2018, and in 2019 was the first year that we saw the impact of it. And the impact of it, the impact of it is as it relates to the small business deduction. So the small business deduction for a corporation is on your first $500,000 of income, of your active business income, you pay a lower tax rate than you do on any income that's earned past $500,000. So a lot of times what businesses do is they will pay out salaries and incomes and things to employees and staff, and sometimes it's a shareholder. And we pay incomes down to that $500,000 level so that the company itself isn't paying the high tax rate on that income. Here's the problem. In 2019, we started with this passive investment income affecting the use of the small business deduction. So the more passive investment income we have inside of our corporation, we end up with a clawback on the use of our small business deduction. So by way of example, if we had $50,000 of passive investment income, we're right at the threshold now of seeing a clawback on the use of the small business deduction. I'm not expecting everybody to remember all of this, but I want you to remember that the small business deduction can be affected by your passive investments. Once we get to $150,000 of passive investment income, we now lose the entire use of the small business deduction. So instead of tax at the low rate, we're paying tax at the full active business rate. And in Alberta, that's a 16% differential in the tax, and it represents about $70,000 a year in tax that we pay that we wouldn't pay if we had use of that small business deduction. So we have to pay attention to this. And one of the things that we can do to minimize the impact of the loss of the small business deduction is to tax shelter money or to defer the tax on money in the investments that you make. So again, another reason for us to think about what are the vehicles that we can use. And obviously, we wouldn't be bringing this up if life insurance wasn't one of those solutions. It's not the only solution, but it is one of the solutions, and it's one of the most efficient ones. Okay.
And it's something we talk about throughout the year too for clients and help them track, right? So we'll help you track how close you are to that threshold. Because sometimes we see even like rental income or rental properties held within a company that obviously, contributes to that passive investment limit. So
exactly. Yeah. So that can be land, that can be, anything that you're renting out. And oftentimes people go, give me a number around that. So even if you're making, if you have $1 million making 5%, that's your $50,000 right there. So that's something that, when you think about it, it doesn't have to be large numbers.
Yeah, absolutely, Pam. Thanks. All right. So moving on, I want to talk about some of the government restrictions on investment income or on investments, because the most common investments that we have out there for people in the general population are RSPs and TFSAs. So the government restricts us from how much money we can put into those vehicles. And they restrict us for a very simple reason. They recognize that people that are maximizing the value of RSPs and TFSAs are wealthy, right? The average consumer that's out there isn't maximizing their RSP or their TFSA. So we see a cap, a hard cap on the amounts that we can put into those vehicles. That's the control of the government. So when we look at investments and opportunities out there, we want to look for things that have less of a cap, but also give the same kind of results on tax deferral. So, the optimal way that I've said this in the past is if I could have a corporate investment that was a TFSA and had no limits on it, that would be excellent. We don't have exactly that, but we have pretty close when we use an insurance policy. And we're going to walk through how some of that plays out and the importance of that. But if we, looking at this screen, one of the key things that I point out is, the government was starting to increase the TFSA limits, and our current government that's in place today decided when we got to that 10,000 number, they came into power and said immediately, that's an area that wealthy people are making use of. Nobody else is making full use of that. We're going to reduce it down because we don't want more people that are wealthy tax sheltering more money. Okay, so there is a control mechanism there that the government uses, and we want to make sure that we utilize the other things like life insurance policies for things that people just don't traditionally think of using insurance policies for. Okay. So if we were building an optimal corporate investment vehicle, I do this exercise with people when I'm meeting with them one-on-one, because I think it's a value for you to understand. So I thought it would be nice to go through this in the presentation today and talk about what features would you want to see. And so what I'm going to do is I'm going to go through each of these. There's 12 of them, and we're just going to talk about it from a general perspective and talk about what each of these things means. And you can decide at the end of each one, would you want that inside your investment, or would you not want that inside your investment vehicle? I think I know the answer to all of these, but everybody has to make their own personal choices. Okay, so we're going to start out with tax deferred growth. So if I had the choice and I had an investment vehicle where any money that grew inside that vehicle was not taxed on an annual basis, that's what tax deferred growth means. I think that's a check mark right away, right? It's one of the most important factors, because if I have tax deferred growth, it means that I don't include that in annual taxation. And if I'm not including it in annual taxation, it also lends to say that I don't have to worry about my small business deduction limits with passive investment rules. So that's a double win on tax deferred growth, and something that I think that most clients want to see in their investments that are inside a corporation. But there's only one vehicle that we really get that true tax deferral of growth, where we get the deferred growth on an annual basis, and we can access that growth on a tax deferred basis as well. And we'll get into how that works, okay? The second one would be no impact on the small business deduction. That's what SBD stands for, small business deduction. That's that conversation around passive investments and does it impact the small business deduction. So if I have an investment that doesn't impact that small business deduction, that's a win for the corporation, because now I'm not worrying about, am I going to lose the access to that lower tax rate on my first $500,000 of income. Okay, again, I think that's a check mark. You have to decide for yourself. Okay. I think a lot of clients, when we're looking at options for investments, want to make sure that if they invest in a vehicle, whatever that vehicle is, that they have easy access to the funds that are in that vehicle. Let's be honest, things change on a daily basis for business owners. Sometimes we have big expenses that come up. Sometimes we have smaller expenses that come up. Sometimes we have things that we want to invest in. We want to be able to access those dollars that we put into an investment. So check mark if we get an investment vehicle that gives us easy access to the money. Okay. This one I think goes without saying. If I could have guaranteed growth in my investment, that's optimal, right? If I could say to you, you can invest in a product that every year it's going to go up, no matter what happens in the markets, this is going to go up. That's a good thing, right? So check mark there on any investment that can guarantee me positive growth on an annual basis. With that goes hand in hand. Once I've earned it, I don't want to lose it. So if I've got guaranteed growth and I can guarantee a no loss provision, again, that's another check mark there. We can make sure that any money that you've increased your portfolio by, you can't lose. That's a really, really valuable thing within a corporate environment. Most of the clients that I deal with work hard to earn their money. They want to make sure that once they earn some more on their investments, that can't go away. They're locking in that growth, okay? Safety of investments. So this comes into, when I buy an investment inside my corporation, how safe is it, right? What's backing that investment? How does that investment work? You know, is it at risk? I mean, there's the guaranteed no loss provision, but how safe is the investment in aggregate? And I want to make sure that I'm investing in something that I'm not worried about the company going out of business, or I'm not worried about the long-term impact of the economy on that business. That's a secure, safe investment. Okay. This comes back to that earlier discussion around what we were saying about the government limits. If I had an investment product that I could have high contribution limits in, that again is a check mark for me, because I know that a lot of clients get frustrated with having that cap so low on things like TFSA and RSPs. Now, not all business owners use RSPs, but the ones that are using them would use them more if they had a higher ability to dump more money into those vehicles. Okay. So again, high contribution limits is a big win, and significantly higher contribution limits exist in what we're talking about, and that's life insurance versus our traditional investments that have those caps on them. Okay. Of course, I want to have competitive returns. I don't want to have all these wonderful features if I'm earning 1%. Right, and 1% growth on an annual basis to me is like running in mud, right? So if I'm earning less than what's happening with inflation on an ongoing basis, that's why am I investing in that asset other than to have a guaranteed value there? Well, I can do those other guarantees and still get a competitive return. That's a check mark. Okay. When we get into the distribution phase, we want to be able to know, I've accumulated all these assets. Now, how do I distribute them? Can I distribute them effectively? And one of the biggest challenges we have with corporate investments in the normal investments that we incur is this: how do I get it out to myself to use in retirement, or how do I distribute it out to my estate, which is my ultimate beneficiary, or to charities, whatever the chosen beneficiaries are, okay? And so I want to make sure that the vehicles that I'm using have a mechanism to get that money out of my corporation. And that's the wonderful thing about life insurance, is we do have a mechanism, and that leads me into the next point, which is the use of the CDA. The CDA is the capital dividend account. Now, I'm not going to define how the capital dividend account works. That's probably a 1-hour presentation for us at some other time. But know that this works in this fashion. When I have a capital dividend account credit in my corporation, it allows me to pay capital dividends to my shareholders. As a shareholder receiving a capital dividend, I receive that tax-free. Okay, that's a win. Anytime I can get money from my corporation into my shareholders' hands on a tax-free basis, definite check mark. Okay. Liquidity options. Well, how easy is it to liquefy my investment, right? So if I buy real estate, that's not a real liquid investment. It does give me tax deferral, but it's not easy to access the money and get all of the cash out of that investment. If I invest in something that is an obscure security, it might not be as easy to access that money or have it very liquid. Now, if I want a really liquid investment, I can invest in something like a bank account. And if I invest in a bank account, I'm getting less than the 1% that I was talking about earlier. Now, what we're trying to make sure that you understand is that what we're offering with life insurance is that you can access your policy values, the cash value of your insurance policy, and it's very liquid. There's many ways. In fact, there's 3 ways that we can access money from your policy. Each one of them has different tax implications. I'm not going to walk through those today. Again, that's another presentation for another time. But understand that I can take withdrawals, I can take policy loans, and I can take collateral leverage loans. And the advantages of having options is that I can pick and choose which option suits me the best at the time that we're making that assessment, right? So when do I need the money? How do I access it? And we're going to work with you on that process, okay? And the last is collateral options. So can I borrow against that asset? So when I have a corporate asset, can I use that corporate asset and borrow against it? Okay, and the value of borrowing against an asset that's held inside my corporation is that I can borrow corporately or I can borrow personally as a shareholder. And when I borrow personally as a shareholder, there's some rules that we have to follow as far as making sure that we have all of the tax implications handled with guarantee fees and things like this. But we can access that money by way of a collateral assignment of that policy. That's a very important feature when we start talking about the retirement and utilizing the money that's in your insurance policy for retirement purposes, okay? So if we had all of those things, all of those check marks, there is no other investment that ticks all of those boxes off except a life insurance policy. And the optimal life insurance policy to use in these situations is par whole life. Okay. So I'm going to answer some questions right away that you might be thinking about, or that people have asked me in the past, just so that we clear some of these off the table. One of the first ones is this too good to be true, right? And if it was too good to be true, it wouldn't be in the Income Tax Act. We certainly would be hiding this from CRA so that they didn't know that we were doing it. Well, in fact, in the Income Tax Act, in fact, Section 148 of the Income Tax Act, it provides specific rules around the use of exempt life insurance policies. Now, there's some key terms in there: exempt life insurance. Exempt life insurance means that it falls within the rules set by Revenue Canada and the Finance Department that allow us to put tax sheltered money aside inside that policy. Now, the limits, as I had said earlier, are quite high, okay? Much higher than what the limits are for your TFSAs and RSPs. So we get some advantage there. And the fact that it's in the Income Tax Act allows us to go forward with confidence that we're going to be able to use these tools, okay?
And CRA most recently looked at it with a change at the end of 2016, and there's advantages to a policy grandfathered under conditions prior to December 31st, 2016, but this concept still works in today's environment. People often think of it like, you know, a corporate asset, which is really important because obviously the name of the game is to hold and accumulate money inside your company, because the company pays lower tax than yourself personally. And by all means, like, we're not suggesting insurance only, but the old method of investments only doesn't work. And the modern way is a combination of insurance as well as investments.
Yeah, excellent. Thanks, Kelly. One of the other questions that I get is, what if I sell or wind down my company? What happens, right? If I have this policy in my operating company and I sell my operating company, what do I do? This is where we do a lot of work up front with you, and we want to make sure that we structure the policy in the right place. So if there is a chance that your operating company is going to sell in the future, do we look at it as a share sale or an asset sale? And we will try, if you only have an operating company and your insurance policy is inside your operating company, to make that transaction an asset sale so that you're not having to transfer your life insurance policy out of your company, because we certainly don't want to sell the company with the insurance policy in it. Okay, so we're going to do a lot of work up front to make sure that if you do sell your company, that you don't have anything inside your company like a life insurance policy that's going to go with the company. Okay, now on the odd opportunity that we run into a client that has a corporation that they're going to sell the shares of, there is a mechanism for us to move the policy out of the corporation, but there might be some tax implications to doing that. So we just want to be careful on just advising to move the insurance policy and not worry about it. So,
and same thing, Brad, if maybe you want to address, like a lot of people who have PCs have to move up to a holding company once they've not practiced anymore, and moving that to
right.
So they have to hold.
Yeah, and so a lot of times when I see PCs, so professional corporations, having you know, the professional retires and they're no longer registered as a professional corp, they can really just leave the assets in that professional corp that now becomes another holding company. Right? It really becomes an investment company at that point in time. We don't have to make a change to it again, unless we're actually selling that professional corporation, right? And oftentimes those professional corporations sell their assets rather than selling the shares of the company. So we should be okay in that situation. So this is a question that I get all of the time. What if the PAR fund doesn't perform as illustrated? The first thing I'm going to say is it never will. So when we do an illustration, the one thing we know for certain is that the numbers are wrong, okay? Because the numbers are only as valid as the dividend that gets created on the policy on an annual basis. And as soon as that dividend changes even once, everything is off, Okay. What we try and do is help people understand that this is a point in time, and this is an illustration of what could happen if things stayed exactly the same. We know that markets go up and markets go down, and that's going to affect the dividend rates that are associated to the policies. One of the things that we can say with strong confidence, though, is that even through the last 15 years or so, when we've been in a very low interest rate environment, we are right now at the lowest values that these par policies have ever paid. Okay, so as interest rates start to rise again, which is what we're starting to see in the marketplace, we have fairly good confidence that the market is going to also help these par policies increase their dividends. So we're really in a position of confidence right now with these policies that, yes, the illustration is going to be wrong, but it's going to likely be on the low side. Okay, and that's a really nice position to be in.
Yeah, and even if and as an example, if we look at an illustration that was produced 10 years ago, and then every third year we're bringing that forward in client meetings. And we might see a negligible decrease from the policy illustration from 10 years ago, but for many of you with us, you're not intending on using that cash value for 10 or 20 or 30 years. And so like you said, Brad, like what's illustrated today will be the lowest value, and every third year, at the latest, when we look at that, we'll see increases in projected values.
Yeah, and a lot of the companies have already increased the dividend over the last quarter here. So a lot of these policies are moving up anywhere from 0.2 to 0.4, 0.5. You're going to see huge increases, and that's like what Brad was saying, is as you're going to see those bond ladders come due, all of a sudden we're getting a higher and higher and higher rate. And of course, rent, as you're noticing with the housing crisis, rent's getting higher and higher, and that's what a lot of these companies use, is rent, mortgages, interest rates. You're going to have that just chip higher and higher, which is, why we've been pushing it, especially for the last couple of years for clients that could do it. It's a great time to purchase when we're at that situation where you're going to see a huge increase when inflation and interest rates could get out of control, where the investment markets don't return that. And that's why you want to have a portion of your portfolio here for sure.
Yeah, absolutely.
And just like we talk about it relative to investment markets, like it's a different asset. It's its own asset class, useful in that context, but it's positively linked to interest rate increases, which we knew were going to return back to normal, right? So, even a normal range pre-pandemic is 4 to 5% there. So.
Yeah, absolutely. Thanks for the comments, guys. And this last question I get quite frequently as well. If this is so good, why isn't everyone doing it? And the comment that I want to make about that is it really comes back to, if I were to explain a TFSA to somebody, I could do that very quickly in a conversation to say, you take your investment, you register it as your TFSA, it grows, you don't pay tax on it, you take it out, you don't pay tax on it. That was pretty easy. That's a TFSA, right? That's easy for the media to explain. Okay. Now, if you remember those 12 points that I talked about, that's not an easy article for somebody in the news to write about. And so writing about the value of life insurance, it happens, but it doesn't go into the mainstream media because it's more complicated for people to explain it in a way that people will actually understand it, other than it being just an insurance policy. It is a very efficient tax vehicle, tax sheltering vehicle. And we really have to do this like this, right? So the individual advisors that are out there that are working with these products are out there telling their clients about these products. And if you're fortunate enough to work with somebody that really understands the value of these products and works well with these products, I've never had a client that was upset that they had a whole life policy. In 30 plus years working in this business, I've never had somebody say to me, oh, this is a horrible policy. I wish I would have never done this. In fact, it's quite the opposite. What I find is that most clients will say, boy, I wish I would have done more of this when I was younger. And now that I'm a little bit older, I still want to do more of it, but I can only do so much. right?
Absolutely. And we're even getting that in these markets. You know, people are going, well, I don't like to see a -3 or -4. Man, this has been awesome. And it performed at 7.5 last year. You know, some
Yeah,
of them giving 5.25 dividend. It's like, well, this is guaranteed, folks, on that dividend that was just given.
Yeah,
You're never going to lose it.
I would
yeah,
suggest that like everyone is doing it that has extra funds in their company that they are wanting to save. If they understand, the details of it, which we're going to go through some of the mechanics and the calculations there too. Everybody that understands those things like jump at it, and they must do it if they can qualify. So not all clients can qualify medically to put that in place. So, that's a little tricky. And I think like as complicated maybe as parts of this may seem, like this is the simplest thing that a company can put in place. Like there's things like pipeline transactions or surplus strips. If a company has more moving parts and more profit and more revenue and more tax consultation needed, which may be applicable to certain people, and that's what generates our work. But for most business owners that have extra savings, this is
yeah.
like almost like a no-brainer, to use that cliche.
Yeah, for sure, Kelly. And one of the things that you guys have talked about is really this. It's not all one or another, right? It's a blending of strategies together. And so one of the things that advisors like Pam and Kelly bring me to their team for is to work with the other professionals that you're working with, so your accountants and your lawyers, to work through what combination of strategies are we working with to make the best solution that works for you specifically. Not just, well, we're going to take this off the shelf and you get that. And the same thing comes off the shelf for the next person, and the same thing comes off the shelf for the next person, right? That's not planning. Planning is customized to your situation, and that's the real value that we're providing when we talk about these things specific to your case. Okay, and what I'm going to do in the next little bit here is I'm just going to walk through some examples of what it might look like for a generic case, right? So let's move into that, and then we'll try and get some questions, and then we'll be wrapping up before you know it.
Yep. Trish, do we have any questions right now in the chat, or does anyone have any questions they'd like to ask before we move on to the case?
I don't have anything yet as of yet, Pam.
Perfect. Okay.
Excellent. Okay, so I did mention that we want to make sure that we understand. There's 3 phases to these transactions. There's an accumulation phase, then there's a retirement phase, and then there's a distribution phase. And what I've put here are the characteristics of each of these phases on a couple of points, right? So if you think about your accumulation phase, you want to see constant growth of your assets. You want to see that asset always growing. You want to see tax efficiency with that growth, right? So, whatever you're invested in, you want to segregate that growth for future use, because you're trying to accumulate it for a purpose down the road, and that purpose is either retirement or distribution, right? So if I don't do that segregation of that asset, what happens is I use it for something else, right? It's very, very easy to use retirement funds or funds that you want to have distributed for other things if it's not specifically set aside, right? I mean, that midlife crisis comes along and I buy that red Corvette, right? I mean, it happens, but we don't want to take it out of this pool. We want to take it out of other assets. Okay, so segregation is very important. And then the deposits. During your accumulation phase, your deposits are really reliant on your ongoing income. So your ongoing ability to earn income drives the ability for us to put money aside for you, right? So we want to make sure that recognition of that ongoing income is there, because without that ongoing income, we're not going to accumulate those funds. Okay, so once we get into retirement, now we're looking for stability of assets. We don't necessarily want to be shooting the lights out during retirement or worrying about shooting the lights out during retirement with investment returns. We want nice, stable growth. We don't want to get too risky with our investments, because we don't want to run out of those investments by using them and by market declines. okay? I know a lot of clients are concerned right now about the markets because funds and investments are down, right? People that are invested in these products, they're not worried about it, right? They really aren't, because it can't go down, right? Again, we still want tax efficiency during that retirement phase. We still want it segregated, but now it's segregated for our current use, not our future use, okay? And we want to make sure that it can produce an income required to maintain whatever lifestyle it is that we're trying to maintain. And that's a portion of the tool, right? This asset doesn't make up all of your assets. So we want to integrate how this plays into enhancing your retirement income, not replacing it. Okay, again, that combination of strategies working together to make sure that it's customized for you. Okay.
Well, just a quick thought there too is like when you get closer from retirement saving into retirement planning, and the 5 to 10 years in advance of that transition date, the blueprint for your retirement income, if we could choose, we would have 10 or 15 sources or streams of income to create a river of your cash flow, right, to fund your lifestyle. So this would just be one stream of income.
Yeah, absolutely. Thanks, Kelly. And when we get to the distribution phase, it comes down to really simple. Let's keep it simple, right? How do I make the transition to my chosen beneficiaries the most efficient? And the beneficiary that I don't choose, which is Revenue Canada, right? We want to make sure that if I'm spending $1 of tax, that I minimize the amount of money that I use to get that dollar. Right, and that's really, really important when we get into the distribution phase, and really plays to the value of the life insurance policy being used as part of your estate distribution. Okay, that is now into the case study. Okay, so we have Sarah and John, married couple. They have 2 children. Nobody's a minor anymore. I didn't want to get into that complication of the estate planning side of things, but we're going to keep this as simple as possible. But these cases get individualized, right? So everybody's situation is different. This is kind of what I do with each client that we work with, is go through this set of facts, right? So Sarah's a doctor with a PC. John is a corporate executive. Sarah owns voting common shares in the PC, and John has non-voting shares in Sarah's PC. Now, this is something that's happened relatively recent in different provinces in Canada, and it's not as widespread yet, but it's becoming more and more widespread that we're seeing the non-professional spouse owning non-voting shares in the PCs. Okay, and this is useful for various reasons, but the biggest reason is once I am no longer practicing as a professional, now I have a holding company and I have 2 people that own the shares in that company that I can pay dividends out to, or accumulate assets within the corporation and access the money in a vehicle like a par life insurance policy. Okay. They're looking to save money in Sarah's PC, as she's retaining about $300,000 a year currently, and she invests that in various things like stocks, GICs, bonds, real estate, and that's what her current portfolio mix looks like. And they're aware that there are some tax implications to growing these assets inside the company, and they want to understand what some of their options are around the tax planning. And I always throw in what's happening with their wills. Like most people, they have what are called mirror wills, which says that I leave everything to my spouse, and if my spouse predeceases me, I leave everything to my children. And then my spouse's will says the exact same thing, just with reversing the names. Okay, that's what a mirror will is, and it's a very, very common structure that I see. In fact, probably 95% of the wills that I review are in that format. Okay. So this is just a visual depiction of what we have. We've got Sarah's PC here, and Sarah's PC has got the voting shares and the non-voting shares for Sarah and John. And then we have a building company, and that's a holding company that holds the building that Sarah's PC operates out of. Now, in the event that Sarah winds down her PC, she may sell the assets of her practice, but she may retain the value in the building, and that's why we've separated that building over there. Okay, so where do we end up with We've got some value in the corporation, in the PC. There's some real estate investments of about $1.8 million. These are other investments other than the building co. And then we've got some cash and bonds and stocks and things that make up about $700,000. She started the PC, so the adjusted cost base for the company is $100. It's nominal, okay? And the fair market value is around $2.5 million. When we look at the build co, we have the same set of parameters, and the fair market value is about $1 million after we depreciate the building, okay? So that's what we have and what it looks like. And so when we look at investments, we want to look at what the tax liability is on the shares in the company. So we want to understand that for Sarah and John, and make sure that they understand that, you know, I've got $3.5 million of value, fair market value, and what's the tax liability on that and how does that work? We also want to understand, how do we transfer the shares of that company or those companies, right? Are those shares being transferred down to the children on the second death? Are they being transferred to a spouse on the first death? How is that all going to operate? That's all part of our planning discussion that we have with clients. We want to understand about the tax sheltering of assets. That's been our whole conversation so far, and that becomes a very important part of the planning process. We want to understand how we're going to extract money from the corporation at retirement and or at distribution, okay? We know that that tax liability is due, but that tax liability is due at the estate level. The money is sitting inside the corporation. We have to get it out of the corporation in order to pay that tax, okay? How does that all work? Okay, that's all part of the planning that we do as part of this process.
And I think some things that we've seen, and just in the background, is like when people come aboard initially and it's all new to them, you know, I think a lot of people don't consider getting those assets outside your corporation can be anywhere from 30 to 46% tax. So, yeah, you know, that right off the bat is something that, you know, I think a lot of people are like, oh, can't I just take a 15% dividend? And that answer is no. So,
yeah, exactly. And you know, even if I could take a 15% dividend, I always say it like this. If I have $1 of tax to pay outside of the corporation, would I prefer to pay more than $1 to pay that tax or less than $1? And if you think about it, if I have money that's inside the corporation and I have to pay any tax to get that money out of the corporation, I'm going to pay more than $1 because I have to get that net dollar out of the corporation. If I'm using a life insurance policy to extract money from the corporation, I'm always going to pay less than $1 for that dollar. So again, that's the value of using life insurance as an estate planning tool, not just as an accumulation tool. Okay. And so then we also make sure that we cover off how this affects the passive investment rules. And when we look at all of these things comprehensively, we get a whole bunch of really good, solid planning that comes out of it on the back end. Okay. So options to consider here, we've got life insurance. Okay, so if I'm going to talk about life insurance, what's the value? So my annual deposits to my life insurance builds a cash reserve that can be accessed in various ways to maximize the value for the family. That's a very strong statement because I've got assets that are growing inside the corporation, inside the insurance policy, but I've also got the insurance death benefit. Those two things working together provide significant value for the family. Okay. Add on to that the deposits that are held in the policy are sheltered from annual taxation, as well as from any negative impact of the small business deduction as it relates to the passive investment rules. So any money that I tax shelter inside that policy, just as a reiteration, Sarah and John aren't going to pay tax on the growth on that, and I'm going to have a mechanism to access that money out of the company. Now everybody wants to know, how do I get my income from this? Well, we can draw income in the future tax efficiently by leveraging against the insurance policy. Now, there's some key words there, leveraging against, right? I'm not actually pulling money out of that insurance policy when I need that money for retirement. What I'm doing is I'm going and setting that policy up as collateral for a personal loan or a corporate loan, depends on how we're doing it, and we'll cross that bridge and work through all of the tax implications of either method. But if I'm borrowing against that policy is still continuing to grow over time, even though I've got a loan against it. That's really the power of using the life insurance policy in retirement, because I can get significant value by not having taxable income because I don't pay tax on a loan. Okay, that gives me a really nice way to extract money out of my corporation, and it doesn't incur any tax. Now, a lot of people don't think about this, but if I have too much income in retirement, I lose my OAS. And the funny thing is OAS is not a big amount for most people. It's a thing of principle, though. We've paid into it all of our lives into the social system, and we believe as Canadians that we deserve to receive those assets back, or a portion of them, through our social program OAS. But if we incur too much income in retirement, we get a clawback on our OAS, and most people that have wealth get no OAS. Okay, one of the ways that we can help offset that income is by utilizing tools like this that don't actually increase your taxable income on an annual basis. And it helps us retain our OAS payments. Again, not a huge number that we're looking for from that OAS, but it certainly is, on principle, my money. Right?
Well, and that $600 per month is, a significant contributor to a solid entertainment budget, right? Like that's one concept, right? One topic of tax efficiency. And that's why we call it a retirement income blueprint, because it's literally detailed like the house plans or architectural blueprints for building. And that's where a lot of people come to know these as tax shelters, right? It's not really the insurance policy. There's people that are going to benefit while I'm gone, right? It absolutely is going to benefit you while you're alive, and that's what we're talking about as a first priority for sure.
Yeah, absolutely. So really quickly, I'm going to run through some numbers. This part of the presentation is not something that I want you to remember. It's just so that you have an understanding of how this kind of works. And then,
come on, Brad.
Yeah, there's going to be a test. No test, Pam. So basically what we're looking at is we've got an estimated tax liability that gives us the justification for the life insurance contract. That's an important part of the planning. We have to justify to the insurance company that we need the insurance. We can't just put these things in place because we want to. There has to be a need there, and we can always establish that need. Anytime that you have corporate assets, we can justify it using the tax liability associated to the corporation. So in our case, if you remember Sarah and John, they had the $2.5 million in the professional corporation, and they had about $1 million of fair market value. So they got about a $3.5 million gain. And on that gain, their current tax liability runs out at about $840,000. So that's kind of my starting point for a life insurance policy. I could start with a minimum of $840,000. A life insurance company is going to say, yes, you can justify that easily.
And that, keep in mind, was from that $100 that you paid for those shares. So a lot of people don't know that, I paid $100 for shares. That seemed really great when I opened my corporation. But now you've got millions of dollars. You do have to pay tax on that differential. And that's where we talk about people with RSPs, because the biggest thing people think is, well, my RSPs are mine. I don't have to pay tax on them. But when you pass away, that's also taxed at 46%.
Yeah, absolutely. Absolutely. So now we said that Sarah is going to invest about $300,000 a year in her retained earnings of the company. And if we use a 5% growth rate on the assets that are there, plus the assets that are going to be contributed over a period of time, that's going to increase her tax liability in a 10-year period from $840,000 to $1.9 million. So you can see it doesn't take long when we start contributing to these this asset growth that we may incur a much bigger tax liability. Now, insurance companies will allow us, and there's specific reasons why I used 5% growth rate in 10 years. That's kind of the maximum projection an insurance company will allow us to look out into the future with confidence and say, you can start at that $1.9 million number. Okay, that allows us to get a benchmark for how much insurance can we apply for without causing an issue with the insurance company for various reasons around insurability. So when we look at option one, we could invest in our current portfolio inside the corporation and do nothing different. Option two is we invest in our current portfolio as we have been doing, but we're also going to take some of that $300,000 and instead of just investing it like we were before, we're going to put some of that into the insurance policy structure. And by taking those two things together, the existing investment growth and the insurance growth, we magnify the value of the cash over time, and we magnify the value of the estate over time. That's a win-win for everybody, okay? And I'm just going to show you what that looks like. I don't expect people to be able to read these numbers. What I want you to see is on the very far right column, it's in kind of a yellowy tan color, is the net estate value is increasing over time. Okay, that's if I do nothing different. Okay, so I'm just going to invest in what I've been investing in, and I'm taxing on an annual basis as if this is interest income. But if you had a portfolio that was made up of different types of income, some of it's deferred tax, some of it's dividend tax, some of it's income, we're gonna customize that spreadsheet for you so that it makes sense for your situation. But just as a general concept, it's growing, your tax liability continues to grow as your asset pool does, okay? And I want you to remember at year, we're gonna pick a year, we're gonna pick year 20. And at year 20, we have an estate value of 4.7 million, okay? I'm gonna flip to the next screen, which is gonna be even harder to read, but I want you to understand that that's the screen where we're looking at the current investment structure with the $300,000 being split between the investment pool and the insurance pool, okay? And we're gonna look at year 20. And remember at year 20, our net estate value, 4.7 million, okay? Option two, we're going to pay $118,000 into the insurance structure, which leaves us with $181,000 still going into the investment pool that we were investing in before. And when we look at year 20, we go across here and we look at the combined estate value, okay? Remember what it was before, right? I'll go back a screen. Year 20, 4.7 million net estate value. Year 20, the combined value of doing this structure is 6.7 million. We have a $2 million bump in the estate value, and I haven't given up access to my cash. To me, that is a win-win, right? Now, for those of you that don't want to read numbers, I do this exercise so that you can see it visually, okay? Blue is your current situation, right? You're just doing the investment pool. Orange is your investment plus the insurance. You can see no matter what year you look at, the values are much higher. If I look out to year 35, which is our long-term planning, I have almost a $4 million increase in my estate value. And all I did was reallocate some assets into a pool that uses the insurance policy, okay? Now,
you still had access to the cash, right? And it's best, I think, like related to maybe the fixed income component or the conservative component of someone's investment pool. And then if you do that and you hold that and you tuck it into an insurance tax shelter, the way I look at the rate of return that we're getting on that cash value is what would that non-registered fixed income, what would it have to earn over the years to equate to that cash value?
Right. Yeah. And that's a spreadsheet that we do develop for you as part of our custom planning, is we do show what the equivalent rate of return would be required. And that usually comes in somewhere around 8%, right? So an 8% investment is a heavily invested in equities. We're not finding anything outside the equity markets that's going to produce 8%. So if I have to get 8% and take risk with my money, why wouldn't I put it into something that I don't have to take risk with my money with, and I'm still getting the same value, right? And
I
that's
think
just
like the key there is to get 8% right now, you're getting minus 20. And
right.
I think, oftentimes people ask, why can't I take more risk? Or what else are you doing that maybe, would raise my equity levels and get me into this market? And I'm hearing so many people buy. That's what that gets you, is so that if you're not a person that's, not happy with -4, all of a sudden getting +8 to minus 20,
Right.
you're going to be like, oh, okay,
Yeah.
I didn't
Yeah.
know
Well,
that, or I
and
didn't
your
understand
corporate
that. And
investment
you're not
pool,
getting that here.
your corporate investment pool will still hold equity and some risk on
That's right.
trades. But then combined, because obviously rates of return and how successful a plan is measured in years. And we can't look at like weeks or months or
Yeah.
quarters. But, I think like it works well. And what you're talking about here is the estate value, because everybody passes away, because the insurance is permanent. The longer that goes as a strategic byproduct, the estate value is that much more magnified using insurance and investments.
Right. And the key to this whole thing is, do I give up access to my cash while I'm doing this other structure? And the answer to that question is no, I don't give up access to my cash. And in fact, you can see that through every year up until year 2021, we have about the same amount of cash and access to that cash in either plan. So I get a much higher estate value if something happens, but I haven't given up use of my cash, right? And then as we get past year 20, you can start to see that the tax sheltering of the money inside that insurance policy, the cash really takes off. And we end up with, at year 30, about $1 million more in cash than we would have had if we would have just left it in the regular investment.
And
Well, that's a
the
very
differential
powerful
in the
tool.
returns that we often talk about with people is, why take on the extra risk when you actually are going to get this plus more later? And that's what the whole key of this is.
Yeah, absolutely. Absolutely. So I just wanted to make sure that everybody understood, if we were to access funds in retirement, what would that look like? And so we're going to just use the same example that we were just using, but now instead of just letting that money sit and grow inside that policy, I'm going to look at, what does it do for me in retirement? Okay, so if we look at the benefits of that, we've got tax-free cash that's not considered income. I mentioned that earlier. We can actually capitalize the interest on the loan, and that's unique to this structure. There is no other way that you can capitalize the interest on a loan that you take from anywhere in Canada. You have to pay the interest on an annual basis, except under this structure. Now, why would the banks do that? Well, the banks are doing that because you're not accessing the values, you're not reducing the values that are growing inside that contract. So because that continues to grow, they're okay with allowing that capitalization of the interest. You can pay the interest if you choose to, but you don't have to. And you get favorable lending rates. Oftentimes these structures are set up at prime +1, prime +0.5, depends on your personal structure and your personal relationship with your lender. All of the big lenders are capable of doing this. There's also some other lenders that we have out there that allow us to structure these things. So there's lots of options in today's world for accessing this cash, and the banks love this because they collaterally assign the policy. It's a very, very secure loan for them. It's some of the best lending. If you talk to any banker that understands this, it's some of the best lending that they have on the books. Okay, what are the drawbacks?
We've had a few people too on this call. I was just going to say, like we've had a few people on this call that are, buying out shares of a corporation to be able to run an oil company. And I think, that's something to always consider. And I often tell people even this story of Disney. And a lot of people didn't know that Walt Disney didn't have a lot of money. He used his insurance policy to leverage. And then when he ran into trouble after he made it big, and he ran into trouble when the parks were having issues, and he borrowed off the policies again. And I think and then he actually used it to do the retirement strategy and the succession strategy. So you can kind of see, if you've ever read the story of Walt Disney, it's a pure story of this type of thing for people's retirement. And I think that's what's pretty exciting, is you see all the uses that you can do, and people who have leverage to do it. And it's like, this can just be bigger and bigger to get bigger and do bigger, better things.
Yeah, absolutely, Pam. Thanks for that. We always have to look at the drawbacks of things, though, right? We can't just say, here's all the benefits, right? This is wonderful. This is the best thing since sliced bread. Well, it pretty much is, but there are some drawbacks, and I like to make sure that everybody understands that. Lending rates are generally variable. So when you do these things, they are tied usually to the prime rate. So as the prime rate changes, so does the rate that you're getting that lending at. Some people are comfortable with that kind of lending and some people aren't, okay? So we have to make sure that everybody understands how that all works and what the implications of that are. The nice thing is you can always turn the tap off and access money in a different way. People are always worried about changes in the government. Okay, so as I had mentioned earlier, the government sets the rules for things and they can change the rules for things. The one thing I will say about these strategies and using life insurance, one, it is in the Income Tax Act, and to make those changes is a big undertaking. It's not something that most governments want to take on, because the process for making changes to the Life Insurance Act and the Income Tax Act as it relates to life insurance usually requires a majority government to be in place, and they usually have to start that process at the very beginning of their term. So it's not an easy thing for them to make changes to these things. Can they make changes? Absolutely, right? At the end of the day, we can't guarantee what the government's going to do in the future, but we do know one thing. In the past, when changes have been made to policies and policy structures moving forward, generally, in all cases, except for one that I can think of in history, everything is grandfathered to the old rules for existing policies. So if you've already got a plan in place and it's already working, the government generally doesn't touch those structures. Okay, and the only time that they did make a structural change, it did make sense in the context of what they were doing. And again, that's a whole nother separate presentation on that topic alone. Okay. The other big drawback is, if you're going to do this corporate structure, you're going to maintain a corporation in the long term. Okay. Most people that are doing these types of structures, though, are intending to keep their holding company or structure in place anyways. Okay. But sometimes people say, I just want to wind everything up. I don't want to be worrying about this when I'm 95 years old. Okay. Again, it's individual to each person. We need to make sure that we understand before we recommend how to structure things, where we're going to put this. These structures work just as well outside of your corporation as they do inside your corporation. So if there is an intent down the road that you want to sell the corporation or wind the corporation up, we can always structure these things personally. Okay.
Well, Brad, I would add too, admittedly, it's been a struggle with a long period of low interest rates. Like for the last 5 or 7 years, especially, that's been, a headwind in terms of participating insurance account growth. But now as rates increase, that'll be better, as well as, when these, obviously this is kind of like case specific or individual specific as we work on a different household. But some people say, well, what's the catch? Once they see these calculations, it's like, this is kind of like too good to be true or a no-brainer, let's put it in place. Sometimes that catch is like insurability or limited to the amount of cash you had at that time. And then over time, as they come to appreciate it more, they wish they could do more. You might be limited to what you first did it at, or you could change and do a new contract and add more, or the conversation comes up to like kids or grandkids. But that's sometimes a bit of a catch, is that you're kind of locked in at the time. So that's why we try to, again, customize it to you. So it's dependent upon what your revenue looks like, what your balance sheet looks like, right? Or even what your risk profile looks like. So if the more conservative of an investor you are, maybe the more you put towards that. Or if you came to us initially with a lot of corporate investments and high corporate revenue, like the numbers that's appropriate for each situation is derived for a calculation that's customized to you.
And I think too, that's why we often collect so much information off of you. And I think, sometimes people are like, oh, why do I have to answer that again? Or why do I have to do this every year? Or why do I have to think about this every 3 years? And really, the only thing that we can guarantee in your life is that it won't be the same 3 years from today, and it won't be the same probably 5 years from today. And being in this business 25 years, Brad's been, 30, we see it all the time. Or we see it where people get sick, or, family members change and something happens to a family member, or you marry, divorce, businesses change, you have COVID happen and tons of businesses changed,
Yeah.
and that's really why we bug people, not only on a budget, what do you have? What are you earning? What are we doing? You always want to make sure that these policies are fitting exactly what this plan is going to do, and we'll bug you on goals, we'll bug you on what's future plans, and it's really to prompt you to actually think about those things, think about the importance of them, because what we want to do is make sure all these plans are all going to click into place for everything that you want to do.
Yeah,
Yeah,
absolutely.
we think in decades, and I think that's the difference. That's one of the strengths we bring to the file. And a lot of people link this to their income or their corporate revenue stream. So they say, okay, well, if I'm done work, then I stop funding the policy, which, it's more linked to your balance sheet. So then, your accountant and, like the team that we lead for you might suggest that we still fund it for several years if we've got extra non-registered assets, or for other reasons in terms of like just supplying money into that tax shelter. As you age, your risk preference kind of goes down. So a lot of times right now, that opportunity cost, that rate of return that we're effectively achieving in here is 8%. If you're 58 or 62 and you are done work, that rate of return might be absolutely sufficient in your retirement income plan. And that's why we might continue to fund it with your non-registered assets.
And it might be in the end, you've lived a good lifestyle for retirement like we're talking about, but we often don't hear about rates of return, or how much people are putting into things. When something happens to you where you're ill, or you're at your end of life, it's like, how can I actually benefit the people that mean the most to me? How can I benefit my churches? How can I benefit the things that mean most to me? And we end up turning a lot of these into big charitable plans for people at the end of the day, because the thing that we find is people don't use all their assets, and at the end of the day you'd like to. And a lot of people kind of say, that last day I'm going to try to spend that 100 grand, and sometimes that's very hard to plan for. Sometimes you don't know when that day is going to be, so it's like, almost all of our clients have had lots of assets left over, and it's like, are we really targeting where you want those assets to go, and how do the charities work for that? Because that's where all of this comes into play, and it should play really well.
And Pam, I think that's a great segue into my last slide, which is my just my illustration of what happens if I put money into this policy and let it grow until I'm in my 70s. And then I start accessing cash off of that policy to enhance my retirement. So what we did in this policy, if you remember, is I put in $118,000 a year. And by putting that in over 10 years, we've put 1.1 million, just under 1.2 million of assets into that policy. And I'm going to start an income around age 75 here, so starting at 76, and I'm going to take income for the next 15 years. So I put in 10 years at 118,000. I'm going to take 15 years, and I'm going to receive 3.5 million. Okay, and remember before I mentioned when we access that money, we're accessing it on a tax-free basis. So not only have I taken 3.4 million, but the value that I've taken is 3.4 million times what I would have paid to pay that if I took it as a corporate investment. Okay, so it's significantly a large value coming out of that plan. Now, I also still have a $1.9 million death benefit at age 90 when I pay off the loan with the insurance proceeds, and I still have 1.9, almost $2 million left for my estate planning. So that's a pretty significant value when you think about what I've done there. I've put in 1.18 million. I've gotten 3.5 million almost out in tax-free retirement income, and I'm giving my estate $2 million. Okay? If you can show me another investment vehicle that can do that, I challenge you now. Okay? The alternative investment would be I just put it into regular investments and I grow it at 3%. Now, maybe I'm getting a better return, but when I get into those retirement years, I'm probably not getting aggressive with my returns. So a 3% might even be aggressive. But let's say I use 3%. If I took the same withdrawals as dividends from my company, I would receive about $1.3 million, at which point I would have exhausted all my investments. I would have nothing to give to anybody from my estate, and I would have gotten about $2.2 million less in retirement income. That's a pretty compelling story.
Well, and that's 3% after tax. So really, in effect, that's like 5.5%. So,
Right.
Compared to fixed income inside your corp, like that's where we literally say, like on paper, this is as close to magic as we can perform related to tax planning. Granted, this person was in their 40s when they started, which is when we, would prefer to kind of like, get in front of people, the earlier the better.
Yeah, absolutely. So with that, I want to thank everybody for your attention and give you the opportunity for any questions that you have. We'll answer any of those questions. You can also file questions into the Tower Group after the fact. If you think of something, if you watch this presentation back and you think of questions, please feed them into the Tower Group. And what we can do is, if we don't have any specific questions today, but some come in over time, is we'll do a little video snippet that we can add on to the back of this, where we're answering those questions for you. Or you can call in for a personal consultation and we'd be happy to work through your file for you.
Definitely.
I'm going to throw it back over to Pam and Kelly here, and we'll go from there.
So we'll just check in with Trish to see if there's any other questions that you've seen.
Yeah, I do have one. It goes back to the corporate asset reallocation plan, the chart there, Brad. The question is, why does CARP value on slide flatten from year 10 to year 20?
Right in here. What we've done in this situation is we've stopped funding the policy. And because we stopped funding the policy, we still have the costs coming off for the contract for a period of time, okay? So until the dividend on the policy is enough to make up those costs, we see a bit of a decrease in the growth pattern on that. And that's just the structure of the contract. If we don't want to see that, we can structure the contract so that doesn't happen. It's just an example of the way that I set this policy up really quickly. And there are 100 different ways we can set up these contracts to make it custom for whoever's investing in it. We can create a straight line growth that never dips. We can create a bigger dip so that there's more cash value in the early years. There's lots of different ways that we can do it.
Yeah, most of you would be familiar with like a 20-pay window, so that you would be maximized and limited by funding the policy for 20 years. In this example, we funded it for 10 years and then basically had it self-funding for that other 10. In reality, for someone in their 40s that has a work trajectory maybe till 60, what we see is the opposite, is by, after 10 years or 15 years, they're asking to fund more or find additional ways to tuck it into that tax shelter as their revenue and income increases.
Yeah, and you could maybe even go to that, that's in that ledger that Brad was kind of saying you probably wouldn't be able to read. If you want to flip back to that, Brad, it'll kind of show you those 10 years. A lot of you guys are used to kind of seeing these ledgers from us because we do them custom for everybody when they come out of this. You can kind of see those 10 years where he has the deposited net insurance, which is the second column. So you can see that 10 years there, and then when it's actually funded afterwards.
Yeah, so again, customized, unique to you, and even for our existing clientele, like we could continue to apply this and speak to it in our regular reviews. And you will see some more of this detail. Like the collateral loan concept is really a lot more valid like in a year or two in advance of needing the actual funds. So here it works best when you're accessing that, call it from 75 or 76 to like 90. So, it's hard to project, hey, here's what your collateral loan would look like 15 years from now, because there's a lot of moving parts there. But the point is that there's a lot of flexibility and options to access that. Like, a lot of people think of themselves as their own bank as they fund it with significant premiums. And then if you need a short-term loan for a year or two or three, that's also available. But here what we've shown is more like a supersized corporate TFSA that you're thinking of as your own pension, and you've got that flexibility to top up your retirement income as you need it later in life.
Yeah, absolutely.
Great. Well, like you said, Brad, this will be an ongoing conversation with clients, and we look forward to doing that more and more, and producing more case consults for new files going forward. So we really appreciate your time.
Trish has another question in here.
Oh, okay.
Yeah, sorry, I'm assuming it goes back to that that CARP slide. It says age closer to 70, is value diminished? Not sure which slide that would be on.
Yeah, we'd have to get some clarification on the question as far as specifics.
Maybe she's meaning the retirement one at the very end where you actually diminish all your funds. Because if you just had investment funds, that shows that investment funds there, you actually diminish your investment funds quicker after 7 years taking a dividend out of your corporation. You actually diminish those funds at that point versus the insurance.
So if we're not answering the specific question, if you could rephrase it for us, or if you want to file it into the Tower Group, we can certainly answer it more robustly for you.
Yep.
Yeah, they came back and said age of investor starting par. So it might be best to, does that help you, Brad? Or otherwise, I recommend reaching out. You can send me an email.
Yeah, I think reach out. I mean, we started this as the investor was 45 years old and contributing until 55, so 10 years. But certainly we can start these things at any age. The difference is that the longer we have to accumulate assets, the better the value of these things are, okay, as far as using it as a retirement income. So that's again why we like to get to people in their earlier years rather than their later years. But it doesn't mean it doesn't work for in their later years. It just means that it may not be as much value as what we can show in this. And that's the other reason why I only did the investment here for 10 years is because I didn't want it to look so big and so much of a difference, because when we do these things for funding for 20 years, you can imagine that the values increase quite a bit more.
Yeah, and some people want to, have these values when they're 70, and it just basically means more premium, and it just basically means the policy has to be bigger. And that's, sometimes we can't make it that much bigger because there's not that insurance need. That's the difference, because the insurance companies aren't going to let you do massive policies if you really don't need them. And that's, you have to look at the actual estate case of it and say, what is necessary for this client to make sure that we have the right amount of insurance to actually generate the right amount of premium. So that's really why we try to massage that, and we try to get the numbers right for people, because everybody's case is totally different. Some people, have no big goals of estate stuff. Some people have huge goals of estate stuff. So it's, you really want to customize everything to what they're doing to their personal situations and how much retirement income they might want, they might need, how much assets that we're trying to get out of the corporation a little bit more tax efficiently.
Yeah, absolutely.
Yeah, it looked like it plateaued there, but it wasn't diminished, right? Like you both have said, over time, both the cash value and the death benefit increase. But great questions, and it leads more to the point. It's almost like a custom suit or a tailored outfit. It can really be individualized, and it's just tonight's goal was to kind of generate some good conversation, as well as revisit some of these topics that we've discussed over the years, and to really highlight the effect not only of the having the cash value growth tax sheltered, but then as a strategic byproduct, that capital dividend account credit, allows a lot more cash value out of the estate time to flow out to your personal situation. So you've almost got your cake and eating it too, in a way, from a tax angle, which is why we hate tax, but it's a portion of everything that we do, and we love it when we can make the tax numbers work with decades of planning in advance to see situations like this. So, Brad, I want to thank you again for your continued work together and your involvement with this presentation, and most importantly, our clients as well to taking the time to listen to all this. This to us, this is fun and exciting, where we can show millions of difference at the end of the day. Might not be as exciting as the favorite Netflix episode, but this is us. This is us making tax and insurance fun. So thank you very much for hanging in and watching and participating for all of our events.
Thank you.
Thanks, guys.
Good night, everyone.
Good night, everyone.